Did you know the government is erasing 39 trillion in debt? This financial repression plan uses your own money. It turns your mortgage into an asset, but quietly drains your savings daily. Will you be a winner, holding real assets, or a victim? The shocking truth about the FED is about to be revealed now. Key shifts at the central bank signal big changes ahead for all of us. A prominent economic figure, known for easing inflation, is influencing policy. His vision includes a strategy to tackle America's $39 trillion debt burden. This strategy directly affects your personal finances and future. Think of inflation as a leaky battery, constantly losing its charge. As inflation rises, the purchasing power of your dollar decreases. Simultaneously, the real value of government debt shrinks significantly, and your own mortgage debt experiences this same reduction in real terms.
As he makes a gesture, accompanied by a soft ASMR-style sh sound.
This subtle mechanism is how financial repression truly operates. History provides a clear blueprint for what's happening now. After World War II, the U.S. debt was 106% of GDP. By 1974, it had dramatically dropped to a mere 23%. This massive reduction wasn't achieved by direct repayment strategies. Instead, interest rates were strategically kept below inflation levels. The government effectively inflated away its enormous debt burden. In this scenario, long-term fixed-rate borrowers emerge as clear winners. They repay their debts with future dollars that are less valuable. Their asset value, typically real estate, appreciates over time. This creates significant wealth through increasing home equity. They are essentially paying less for their homes each passing year. This strategy allows them to build wealth while debt diminishes.
You need to pay attention to this imbalance. Your debt is weighing you down far more than your savings can counteract.
Conversely, those holding cash and savings accounts are the losers. Their accumulated wealth is quietly eroded by persistent inflation. Interest rates offered on savings rarely match the true inflation rate. Bondholders also suffer, as fixed returns lose real purchasing power.
The system silently siphons their hard-earned money to sustain itself.
This hidden tax disproportionately affects prudent savers and retirees.
Now, let's talk about 3 specific moves to protect your finances. First,
examine your mortgage repayment schedule very carefully. If your interest rate is below 5%, do not rush to repay it early. That money is better utilized elsewhere, growing faster than your debt. Let inflation erode the real value of your fixed-rate debt over time. This is a key strategy for leveraging financial repression to your advantage.
Invest in your future. Transform your ordinary savings into extraordinary growth.
Second, it's time to optimize where you keep your emergency savings. Traditional big banks offer abysmal interest rates on your cash. Move your funds from these accounts to high-yield savings options. These accounts offer significantly better returns, mitigating inflation. Even a few extra percentage points make a huge difference. Don't let your money sit idle, losing value every single day. Third, and perhaps the most powerful, leverage your home equity. Your home's equity is a powerful, often untapped, financial tool. Consider drawing funds from your real estate to invest wisely. Invest specifically in hard assets that produce consistent cash flow.
Examples include income-generating rental properties or commodities.
These assets tend to appreciate and provide income during inflationary periods. Transform your dormant equity into a dynamic, wealth-building engine. Take control of your financial destiny in this new economic landscape. Financial repression is a covert government strategy to reduce debt. It uses inflation to silently erode the real value of debts, and it directly impacts your mortgage debt and personal savings. Understanding this mechanism is your first step to financial resilience. Remember move 1. Don't rush to pay off low-interest debt early. Move 2. Migrate your stagnant savings to high-yield accounts. And move 3. Strategically leverage your home equity for growth. These 3 actions are crucial for thriving in this economy. Proactive steps today. Secure your financial future tomorrow. Don't be a victim. Be an informed participant, a winner. The power to navigate this financial landscape is now in your hands.
Apply these insights immediately and safeguard your wealth.
Your financial freedom depends on understanding and action today. Stay informed, stay smart, and stay financially empowered.